the silver miners versus the gold miners, that's when you're going to see an echo effect of what silver's doing versus gold, breaking out. In which case, the best place to be among the miners should probably be some emphasis on the silver miners. I think they have much more potential percentage gain, and it could be very dramatic. I don't just mean doubling, if you know what I mean. I mean dramatic. And it's a tiny little sector.
The idea really came, this come throughout history. And it's been proven over and over again that the whole system is based on trust or confidence. And of course, the con man is the word for gaining your confidence and swindling you. So over time, if you go back to the monetary history of the United States, for example, they had a script that was issued by the colonies and it worked for a while. And then the Brits came in and counterfeited it and printed too many, and basically the paper money system failed. So when the founding fathers wrote the Constitution, it was written that basically gold and silver would be the only acceptable. And the reason it is it's a trust mechanism outside of man's interference.
At least match the old highs, and everybody will think it's overdone there. They think it's overdone the whole way up, and I love that because that keeps it going. If everybody's on board, and we know that the Western world, especially the U.S., is not on board, the average investor. When they finally get in, it's going to be a wet bar of soap type phenomenon. Especially silver. My own personal conviction, my personal positions in markets, heavily emphasize monetary metals, but especially silver. Now, on this page, we show the gold miners going back to 2013 versus S&P. They've also broken out. Then the bottom chart there is silver price divided into S&P going back to 2013. You also had a downtrend. You broke out above it too. So all the monetary metals and their miners just broke out over an 11-year wide performance base. It's just begun. It's not just gold. It's the miners as well. It's silver. Monetary metals and their miners have shifted into bull phase versus paper bubble. And the next page is the most illuminating of all, if you want to do that one.
Absolutely.
Okay, the top chart is back to 2020. Silver versus gold. You divide an ounce of silver into an ounce of gold, express it as a percent. And back then we were under 1% in early 2020. And it exploded to 1.5% in a matter of a year. That was during that 2020 surge in the monetary metals. Gold went up 40%, silver doubled. So the spread increased. After that, silver, though going up in price mostly, had an erosional backing off on the performance. And it developed a downtrend and also a green horizontal ceiling. It blew through both last month. It's fully broken out of a massive base that goes back to 2021 on that green line, which is the most important one. So not only are the monetary metals now going to beat the S&P, but within the monetary metals, silver is going to lead gold, is our argument. And I have certain expectations of silver that are rough, but at minimum, I think you could see $200 silver in the next 6 months or so. Sounds lunatic? No. There's many other historical comparisons where other markets have done comparable events with far less fundamental driving factors than silver has right now. And it wouldn't shock me to see silver at some point in the next couple of years during this, what I think is an oncoming crisis, to be $1,000 an ounce. God knows where gold might be at that time. It might be highly likely to be institutionalized as a money unit again. This country, that country. A growing contagion of people saying, hey, this fiat stuff hasn't worked. We've been playing with it for 100 years and it's just created boom busts. Let's go to real money. It takes pain to cause that kind of rethink, but I think that's what we're about to step into.
Analyzing performance since 2013 reveals a structural shift. Gold miners, silver miners, and the metals themselves have all broken free from long-lasting downtrends. These weren't minor technical moves. They represent an 11-year base giving way to renewed strength against major stock indices. Silver's ratio relative to the S&P 500 has turned decisively higher, reinforcing the shift from financialized paper assets toward hard asset demand. These synchronized breakouts suggest something larger than a typical commodity cycle. Miners, metals, and monetary hedges are acting in unison, signaling a transition from a passive phase to a full-scale bull environment.
Believe it, I believe, and I believe that money is power at some degree. And if you look from the top down, if you look at the political class, a lot of them are basically bought and paid for. These are people that align with the lobbyists, and the lobbyists are the ones that influence the Congress and the senators to provide the new legislation. So from the top down, you see this idea that money has a power and control over society. And in a true representative government, as I mentioned in the early days of the Roman Empire and in the founding principles of the United States, basically the political class was supposed to represent us. Now they represent corporations, and people don't really understand how really impotent the political class truly is. Most people believe that the politicians have a great deal of power. The most powerful man on the planet is the president of the United States. That's absolutely complete and total hogwash. The truth is, it's the corporations that run the legislations, that pass the bills, that get the let's say, tax advantages to certain entities because they have the power to control Congress to get the legislation in their favor so that they can be more corporate farms rather than mom and pop farms. That's one quick example, but I could go on, but I'm certain, Yanni, that you've got the idea and might want to expand on it.
Silver's performance relative to gold often determines the intensity of metals rallies. In early 2020, the ratio surged dramatically as silver outpaced gold nearly 2-to-1. After cooling for several years, that ratio has finally smashed through both its downtrend and horizontal resistance from 2021. Historically, when silver regains leadership within the precious metals complex, explosive moves follow within months. Current breakouts imply silver could dramatically outperform gold again, possibly doubling or tripling relative strength before stabilizing. Markets with far weaker fundamentals have produced similar gains, and today silver carries extraordinary catalysts: structural deficits, industrial pressure, and tightening global supply.
We'll talk about this chart here. If you take this one back 50 years, everybody looks at the ratio scale. Fine, it's fine. It's just an upside-down version of this. The bull market in 79-80 took silver to 6.5% of the price of gold. Okay. The bull market in 2010-11, when silver hit $50 again, was at 3.5%. Right now, this chart is not up to date. Right now, we're pushing up toward 1.4%. But even 1.4 to go up to 3.5, which it was during the last bull market, is a huge gain. It's almost tripling in the relative value of silver to gold. God forbid you go to the 1980 peak reading, which would have 6.5% the price of gold. And silver's not going up, by the way, and gold's sitting still. So as we're measuring silver relative to gold, we're measuring silver versus another rising market as well. So it's kind of hard to tell. We think this spread is likely to go in this surge up to at least 3%, meaning silver should at least double and a half. And once the spread breaks out, by the way, which it has just now, silver gold, you go back to 79, you'll see a similar incident in the summer of 79. 5 months later, silver quadrupled to almost quintupled in 5 months. 2010 to 11, the last 7 months of that bull trend, silver doubled in a half in 7 months in net price. Think about it.
Every monetary system eventually reaches a reckoning. Throughout history, nations have cycled between commodity-backed money and fully fiat currency, always returning to tangible stores of value when trust erodes. Today's political and corporate landscape further accelerates this breakdown. Legislative influence rests not with voters, but with financial elites and large institutions that shape economic rules to their advantage. As global debt grows and the dollar's credibility weakens, more countries explore gold-linked settlements or alternative reserve systems. A major crisis could trigger a widespread reevaluation of fiat currency, reviving metal-backed units or new forms of asset-based money.
This is my position. Everybody's different because everybody has either more money, less money. more time sensitive, less time sensitive, doesn't want to do leverage, etc. I'm entirely in silver portion of the monetary metals. I own calls on SLV. AGQ is a double ETF of silver. I own that. I own the top four biggest silver miners. I also have long-term or leap calls on the top four big silver miners. I own about 7 or 8 junior miners, and I'm likely to increase that. I think in particular, as silver explodes, the silver miners will go absolutely berserk. They are vastly undervalued to gold miners. And you'll see on the bottom chart there, that's SIL versus GDX. That's the silver miner ETF versus GDX, which does contain, by the way, some silver miners. Look at that spread. It's crowding for the last 4 months, that green line. And right now, I think you're marginally above it. This is as of last month's close. So when that breaks out, the silver miners versus the gold miners, that's when you're going to see an echo effect of what silver's doing versus gold breaking out. In which case, the best place to be among the miners should probably be some emphasis on the silver miners. I think they have much more potential percentage gain, and it could be very dramatic. I don't just mean doubling, if you know what I mean. I mean dramatic. And it's a tiny little sector.
Over the last 50 years, silver's peaks relative to gold have marked extreme phases of monetary stress. During 1979 to 1980, silver reached over 6% of gold's price. The 2011 run topped out at 3.5%. Today, the ratio is barely approaching 1.4%. Even a move back to the last cycle peak would imply silver doubling, and surpassing the 1980 level would produce gains that seem unbelievable until history is examined closely. Silver rallies rarely move gradually. Once the ratio breaks key resistance, past episodes show explosive periods where silver multiplies within months, dragging miners into even larger percentage gains.
The idea really came, just come throughout history. And it's been proven over and over again that the whole system is based on trust or confidence. And of course, the con man is the word for gaining your confidence and swindling you. So over time, if you go back to the monetary history of the United States, for example, they had a script that was issued by the colonies, and it worked for a while. And then the Brits came in and counterfeited it and printed too many, and basically the paper money system failed. So when the founding fathers wrote the Constitution, it was written that basically gold and silver would be the only acceptable. And the reason it is it's a trust mechanism outside of man's interference. It's a piece of gold, it's a piece of silver, and it is a certain weight and a certain purity. And as long as those remain, then everybody can trust it. You don't need to have a counterparty to bless it or put up, a president's picture on it, or for someone to tell you what its value is versus a different currency or any of that stuff. So it has value in and of itself, and everybody agrees to that. There's two theories of money. One is specie money or commodity money that I just described, where everybody more or less agrees that it has value and that the value is determined in each interaction of going, the coat for the money type of thing. And then there is the legal form of money, where the higher power of the society, meaning the government, will mandate or decree that this is what is money and this is what you must use. Otherwise, it's against the law and we're going to put you in a cage. And that, of course, is the way the money powers operate. So it usually fluctuates, very broad brush view, very, not inaccurate, fairly accurate, but certainly not all the intricacies that are involved. But you go from a sound money system, bimetallic or monometallic, to a fiat failure, back to a gold standard, to a fiat failure, back to a gold standard. That's kind of been, again, the broad brush view of monetary history. Now, it's leaving out a lot, but it also does give you the idea that once these currencies do fail, that there's got to be a principle that is reenacted that brings trust back into the system. This time, I'm not so sure. This time it appears with my study that the leap from a fiat system And many of my peers disagree with me. They think we will go back to, gold or silver or sound money tie
Hmm.
again, and we may. That's certainly what history shows. But I'm more of the idea of what they've told us, the bankers, that they want a central bank digital currency or some type of digital surveillance type of money system that gives them even greater control than they have now with a cashless society and the ability to only be able to use money if you have a digital ID, which is basically your DNA. And once you have given them that, then you have the ability to do commerce. And if you don't do that, then you're outside of the new system.
Most silver in the global supply chain comes as a byproduct of copper, zinc, and lead mining, meaning primary silver supply barely responds to rising prices. This creates extreme leverage for dedicated silver miners, especially smaller operations. If silver climbs rapidly, these companies instantly reprice as if their underground metal were bullion trading far above previous valuations. That dynamic has triggered extraordinary gains in past cycles, and current charts show silver-focused miners preparing for a breakout relative to gold miners. For investors positioned early, the upside is not incremental. It's exponential, driven by scarcity demand and structural deficits.
Fortunately for silver, the fundamental is that most silver doesn't come from silver mines. It comes from base metal miners who produce silver on the side as a marginal product. Hence, their primary motivation or profit-driven factor is the price of copper or the price of some other base metal, not the price of silver. It doesn't motivate them to mine more copper to get the little bit of silver they get out. So the silver miners are highly focused little beasts that even if they're tiny little guys, and maybe the cost of production at $30 an ounce was not really good for them. Now suddenly we're pushing towards 60. What if suddenly you're 150? Suddenly these once seemingly worthless little mines, which have the real thing under the ground, think about it that way. They got the bullion under the ground. Suddenly are perceived to be, holy cow, I'm buying this little junior miner. What I'm really doing is buying bullion at 10 cents on the dollar. Okay. So that's why my emphasis is there.